Joining us now, Unlimited Fund CEO and CIO, Bob Elliott. Bob, the banks might have the money, but they want to lend out less of it, at least according to this senior loan officer opinion survey results we got today. What does all that mean for the market?
Well, I think the senior loan officer survey mostly confirmed the picture that actually existed even ahead of SVB, which is the combination of rising interest rates has slowed the demand for credit and caused banks to pull back on their credit extension. I think the big question with the senior loan officer survey was whether there was going to be a more acute tightening of credit standards than people expected. And if anything, it surprised to the upside. The change on credit standards from the first quarter to the second quarter certainly was pretty modest, all things considered.
So, I mean, we're caught, as Mike Santoli was just telling us, as a market in between fear and greed, or fear and courage, I guess we call it now. Where would you lean now based on where the valuations are in the market, the risks that you see ahead? As an investor, should you lean into the caution of fear or, the courage?
The push-pull, I think, captures it well, because you basically have two big offsetting forces in the economy right now, with the macroeconomy being quite strong. Unemployment rate continues to fall. It's at secular lows. And at the same time, some of these concerns or risks from the regional banking sector. I think when you add it all up, it certainly looks like the economy is able to weather some of these challenges in the regional banking system, and that it keeps plugging along despite the fact that certain banks are running in and have run into some trouble. So my guess is the better bet is on a continued strength and persistence and durability of the macroeconomy, and that shows up in different places across assets. You'd probably, the bond market is really very much pricing in a relatively rapid deceleration of inflation and growth. And that's probably the place that looks most inconsistent with the courage that one could expect from the overall macroeconomy.
At the same time, Bob, if you had to write a screenplay scenario for a debt default, and you'd probably have to write it yourself because the writers are on strike right now. It seems like this is the kind of situation where you've got McCarthy, you've got Biden. Both of their jobs are at stake, arguably, if they get this wrong, and each thinks they can blame the other party at the same time. I mean, why is the market not concerned about the debt ceiling right now when, Yellen continues to tell us the X date is about 3 weeks away?
Well, there's certainly some concern amongst money fund managers or money managers that are concerned about holding T-bills that are beyond the prospective X date, concerned that there might be some risk in holding those securities.
Well, yeah,
I think
but I mean, nobody is going to feel moved on Congress to action because of money fund managers' concerns, right?
Yeah, I think the basic idea that most people have is we've been down this path before a few times, and there's a lot of people are beat their chests and say, I want this, I want that, and in the end, we all know that the government has to raise the debt ceiling, and so the question is, are they gonna not do what they're meant to do, what their responsibility is to get that legislation passed. And I think, most people are betting that at some point they will be able to do that, and they'll get it done before there's a meaningful hit on the economy.